Today is July 17, 2026, and the institutional story in digital assets remains less about headlines and more about infrastructure. Across XRP and HBAR, the latest developments continue to point toward regulated use cases, enterprise rails, and measured adoption. On the XRP side, one of today's clearer examples of market noise colliding with market structure is the viral claim that an XRP ETF had attracted $71 million in assets. The filing shows something very different: 12,380 shares valued at about $71,059, not $71 million. That gap matters. In a sector where narratives move faster than disclosures, the institutional lesson is simple. Filings, not social media posts, define the actual state of adoption. For XRP, the more important story is not a speculative headline, but the continuing build-out around regulated financial products and market plumbing that can support institutional participation. Another XRP development worth watching is the report that Ripple's largest shareholder is building institutional XRP lending in Japan. That is a more substantive signal because lending markets are a core piece of financial infrastructure. Institutions do not simply need a token. They need liquidity, custody, settlement pathways, and legal frameworks that fit established finance. Japan has long been a meaningful market for regulated digital asset experimentation, so any move toward institutional lending around XRP reinforces the idea that the network is being positioned for utility inside existing financial systems, not outside them. There was also mention of gradual integration involving the DTCC and the XRP ledger, with the emphasis on tokenization and modernization rather than any binary outcome. That framing is important. Large market infrastructures tend to move in phases. They test, they segment use cases, and they adopt specific functions before broader implementation. In that context, any reference to ledger integration should be read as part of a longer modernization process, especially where tokenization and settlement efficiency are the focus. Turning to HBAR, the latest enterprise signal comes from Utila integration, which expands institutional access to Hedera. This is the kind of development that matters in a network built around regulated use cases. Institutions rarely adopt a ledger because of marketing. They adopt through custody, access, compliance tooling, and operational controls. When integrations improve the ability for institutions to interact with Hedera, that strengthens the network's enterprise thesis in a practical way. Another relevant HBAR item is the continued attention on Hedera Governing Council and enterprise participation. Even when the market is focused on price, the real differentiator for Hedera has always been governance and corporate alignment. That structure is designed to support predictable, enterprise-grade decision-making, which is why council-related coverage remains important. It signals continuity in the network's institutional positioning, especially as tokenization and regulated digital infrastructure remain active themes across the market. The broader signal today is consistent across both networks. Institutional adoption is not a single event. It is a sequence of small, verifiable steps: filings, integrations, lending structures, custody access, and enterprise governance. XRP continues to be framed around financial market infrastructure and regulated liquidity, while HBAR continues to emphasize enterprise access and tokenization readiness. The price action today is modestly lower, but the strategic story remains centered on utility, not speculation. That is the key takeaway for today. Watch the infrastructure, watch the filings, and watch the integrations. Not financial advice, educational content only.